Well, it looks like that call for the bounce was premature, to say the least. We are seeing a massive amount of carnage in the markets right now, with Wednesday posting the largest single day drop in the Dow since 2020. So we are going to take a look at what can people actually do during times like this, when if you hold cash, you're getting slaughtered by inflation. If you're holding, it seems like, any assets, you're getting slaughtered by the carnage, by the sell-off. So what can investors actually do with their money right now? The answer might surprise you. Ready? Let's dive in. All right, guys, so I told you that my answer about where investors can place their money right now, I told you it might surprise you, especially coming from me. If you want to spoil the surprise, feel free, obviously, to fast forward to the end of the video, but I invite you to hang along with me for the ride. But first, a word from today's sponsor, Masterworks. In today's markets, it's becoming harder and harder to allocate your investment portfolio in a way that, number one, both protects you from inflation, and number two, diversifies you to the point where if something gets crushed, it doesn't affect the rest of your portfolio. We're seeing more and more volatility in stocks, in bonds. Cryptocurrency is starting to fall apart, and even real estate now, many people are scared that we have finally turned the corner, and because of higher borrowing costs, there are not enough buyers to keep prices where they are. And that's where Masterworks comes in. Masterworks allows investors to have access to an asset class that most people, for most of history, have not had access to. If you wanted to invest in art, you are stuck choosing between buying something that is most of your net worth from an artist that is well known, that has a high likelihood of preserving its value over time, or you have to place your bet on an unknown artist simply because you can afford them. You don't want to place everything in one basket. That means only the ultra wealthy had access to be able to diversify their money and place a portion of their money in contemporary art, in the high value art, but Masterworks is changing the game. Masterworks allows anybody to invest in contemporary art from artists like Banksy, Monet, Picasso. These pieces of art are securitized. They are divided up into shares that people can buy fractional ownership of these pieces of art, and they can even sell these shares on the secondary market at Masterworks. The way they've been able to do this is to offer these investments under Regulation A under the Securities Act of 1933. And on top of being a way to diversify your portfolio and add in an asset class with low correlation to your other asset classes, it has outperformed most other asset classes as well, with contemporary art outperforming the S&P 500 over the last 20 years, and specific pieces that Masterworks has offered reaching returns of 32%, 31%, and 33%. There is a waitlist, but if you use my link in the description of this video, you will be able to skip that waitlist and start investing in contemporary art today. All right, so what is going on with the stock market? Let's take a look first at the S&P 500, and we can see this massive red candle here. We've basically retraced all the gains that we got over the last couple of days. This little bounce is basically over. We're back down to where we were at the bottom of the sell-off earlier this month. Same thing with the NASDAQ, same thing with the Dow, although much worse with the Dow. And the Russell 2000 is actually not as bad. If we look at the Dow, though, that is the biggest single-day drop since 2020. So during this sell-off that we had in March of 2020, obviously there were some bigger down days, and those are some of the biggest down days in stock market history. But zooming out here, we are not far off from hitting the highs before that March 2020 sell-off and the high of the recovery before January of 2021 there. We are basically getting to the point pretty close here of retracing all of the gains that we experienced through 2021. I recently made a video that it might be time to buy the dip because the fear and greed index is sending a big buy signal right now. We'll see if that pans out to be true. Right now, it looks like we have a little bit more fear to go. We are experiencing still extreme levels of fear here. And so as the fear and greed index starts to rebound here and we start to see more levels of greed instead of fear, you would expect to see a rebound in the stock market as well. But right now, it doesn't seem like we are going to be getting any of that. Let's move on to gold because we are seeing some selling pressure happen in gold as well. The price of gold for years now, since 2018 has followed this rising trend line here, and it broke out from this wedge earlier in 2022 in February here. It broke out, and then on fears of war, spiked to this all-time high level here, subsequently sell off. And I've been watching this this blue line, because again, that's the trend line that it's been following since 2018. I've been watching that very closely. I saw the bounce here. I was looking for a retest and another bounce, but obviously we did not get that. We broke through and retested the resistance line that was formed during this wedge for 2 years there, and broke through that as well. We've come back in, retested, and have not been able to break through. So I would anticipate in gold more pain. Since we broke through that key support level, I would anticipate a little bit of a significant sell-off here. I don't think we've seen near the bottom in gold yet, and then that means that we are also expecting some more selling and some more pain in silver. Silver, there's a more significant support line here at 22. That we broke through, more of a significant, because it is horizontal for some reason. Horizontal support and resistance lines tend to perform much stronger than diagonal lines, and we broke through that with silver. So I would anticipate that we get more of a significant sell-off in silver here, potentially, filling in this gap. There's a huge gap there where there's not much volume historically, getting it down to this sub 19 level here, potentially even down here to this 18-20 mark. Again, back in this time frame here, we're filling in this gap where there's not much volume from silver here. So based on that, I would not be surprised at all if we experience some more pain from gold and silver moving forward into the coming weeks. So the big question is, why is this happening? Number one, stocks are selling off. Number two, gold and silver is selling off. Number three, Bitcoin is selling off. Everybody's been talking about that. Again, some key support level here that it looks like we are not going to be able to bounce back up and stay above. It looks like this 29, 28 level is going to be breached. That could take us easily down to 20,000 here, which would be a clean support line there at 20,000. So we got crypto selling off, stocks selling off, gold and silver selling off. Meanwhile, inflation is raging. And so if you have your money in cash, look at the DXY here. The DXY is the measurement of the dollar versus other currencies. So we've seen the dollar just spiking. The dollar is at, almost 104 here, hit 105 a few days ago, but we've seen just a massive rally in the dollar, but that doesn't have anything to do with inflation, right? The DXY can go up because it's just the dollar gaining strength versus other currencies. Has nothing to do with the dollar strength versus goods, versus services, versus food, versus energy, versus housing, versus cars, versus clothing, versus the stuff that people need to buy. The DXY doesn't really have anything to do with that. So people talk about a strong dollar. Yeah, we've got a strong dollar versus the currencies that it's being measured against, but that doesn't mean that it's strong in your wallet. That doesn't mean that you can spend, those dollars will go further. You're actually experiencing inflation right now while the DXY is going up. Those two things happen simultaneously. So every month, your food gets more expensive, your clothes, your gas, your cars, your rent, your mortgages, whatever you are spending your money on, the cost of living is going up. And so the dollars in your bank account, if you have 3 months worth of expenses in there, which I think is good, 3, 6, 12 months worth of expenses in cash, that's absolutely fine. That is going to need to be replenished. That means that you are going to have to continue to put more and more cash in there just to keep the same amount of purchasing power. If you want 3 months worth of expenses, you have to keep on adding more and more cash to that every month just to keep at 3 months worth of expenses. And so there's a leak on the value of the dollar, a leak on the purchasing power of the dollar. So you can't keep money in cash. You can't put money in stocks. You can't put money in crypto. You can't put money in gold. You can't put money in silver. And while we're at it, let's take a look at gold stocks, because I've been talking about gold stocks forever, saying that they're the best value in probably one of the best value asset classes in the world right now for the next decade. I still strongly believe that, but take a look at this chart. We've had just an insane sell-off in gold stocks. This is GDX, so it measures most large gold stocks here. Insane sell-off from 41 down to 30. In percentage terms, that is a whopping 25% sell-off here in just 1 month. Absolutely crazy here. We've retraced all the way back down here. When the GDX was up at 41, 42, gold stocks were still on sale. Gold stocks are producing. They're pulling something valuable out of the ground and they're able to sell it at a profit. At gold at 1800, at 1700, at 1500. Companies that pull that gold out of the ground and can sell that are selling that at a profit. Whether it's at 1500, 1400, many of these companies are profitable down to $1,200 or even $1,100 gold. Yet they're selling off as if they're pricing in major losses. Some of these stocks are now even selling near book value. Absolutely crazy times going on right now. So you're looking at, hey, we've got inflation, so you'd expect things like gold to go up, you'd expect things like Bitcoin to go up, you'd expect things like stocks to go up, because as costs go up, that means revenues for companies are going up, but we are seeing weaker and weaker demand because there's less purchasing power for everybody to be able to maintain their cost of living, so people are having to pull back, and so we're seeing stagnation or a reduction in economic activity, along with prices going up. That's what stagflation is, which means that basically investors are saying, there's nowhere to put my money. Now, this is where we get to the answer that might surprise you coming from me. I know it might be time to consider treasuries. So don't come at me here, because this is something that I'm not recommending, obviously not investment advice. I don't know you, I don't know your personal circumstances, and I'm not saying that I think this might be a good long-term play. But I think it's very likely we have one more leg up in the bond bull market. The long-term 40-year bond bull market that we've had since 1980. Possible we have one more big leg up, and here's why. Take a look at the 20-year. The 20-year here peaked recently, I'm going to say at 3.5. The 30-year also peaked at about 3.2 here. Rates came back up, almost retested, and have started to fall back down again. Same with the 20-year. Came back up and have started to fall back down again. The 10-year is showing a head and shoulders formation is starting, and the 2-year is sputtering out here. What are we seeing here? We're seeing rates are peaking. Why are rates peaking? Because more and more big money is getting ready to pile into bonds. Potentially. I'm not saying definitely. This is something Harry Dent talks about a lot right now, that it's very possible we get a massive move up in bond prices. Remember, we were looking at rates. Now let's look at bond prices through TLT. This is going to be 20-year plus, and then ZROZ is going to be 25-year. So these are going to be ETFs you can take a look at for going long U.S. Treasuries. If we take a look back at TLT here, remember, prices of bonds and interest rates on bonds, they're inversely correlated. So as bonds go up, as yields go up, bond prices go down. So everybody's been selling off bonds. Why have they been selling off bonds? Because inflation. Why would you hold something at 3% when you're losing 8% every single year? And so people have been selling bonds. Also, the Fed has been pushing up interest rates. So if the Fed pushes up short-term interest rates, that affects the rest of the curve. If you anticipate rates to go up, that's the same thing as saying you anticipate prices to go down. So everybody who has the ability will sell to anticipate that and then buy back in at a lower price later. But the problem is, everything else is collapsing right now. Everything else is going to garbage. And what happens when economic collapse really sets in? What happens when the stock market really starts to crash? People pile into safety. And I don't believe that treasuries are the safe haven asset, but a lot of people do. A lot of big money managers do. And so we've had really terrible performance in every asset class big money managers are starting to position themselves, slowly get out of stocks to get into the safe haven asset. We've got stagflation. We've got a recession happening right now. We've got inflation happening everywhere. We've got weakening demand popping up all over the place. This is not a time where money managers want to be aggressive. This is where they want to place their investors' money in safe haven assets. I think that's gold. I think long term, it's very, very likely that's Bitcoin. I don't think that's treasuries long term, but most people who manage large amounts of money disagree. And so if most people who manage large amounts of money are going to be doing something, you can front run it. Might be worth buying some calls on TLT, some calls on ZROZ. That's what I did. Not a massive position, but just to speculate, hey, if a bunch of money says, hey, risk off, we need safety, they're going to pile into treasuries. That's going to drive things like TLT way back up. That's going to drive interest rates way back down. And the key thing here is that it doesn't matter what the Federal Reserve does to short-term rates right now. I'm going to show you a chart that explains what I mean. This is the overnight reverse repo facility at the Federal Reserve. There's 1.9, almost $2 trillion worth of cash in here. At any point, the Federal Reserve can take the rate that they're paying into this account. Anybody who puts money there, they're getting 0.8% right now. That is 0.05% above the federal funds rate. So it's pulled in a lot of cash from the system. At any point, the Federal Reserve wants, if things get too dicey, they can pull this rate down below the federal funds rate, and that $1.9 trillion worth of cash floods out into the market and has to find collateral otherwise, has to find other safe assets like short-term U.S. government bonds. The Fed can tighten, they can raise rates, they can sell assets off their balance sheet, and at the same time, they can force more cash out into the system to buy up the bonds to stop those rates from going up just by lowering the rate that they're paying into the reverse repo facility. We will see that at some point. I just don't know when. So it is likely, again, I'm not making a claim that this is for sure. I'm just saying it might be worth a little bet. Put some money in treasuries because it's very possible we get a big flood of institutional money into treasuries as the economic conditions around the country get worse and worse and worse. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.